Good afternoon. This is Sean Golding with Golding & Golding. I hope everyone had a good second half of their tax season. Today's presentation is going to focus specifically on IRS Form 8854, which is used as the initial and annual expatriation statement for certain taxpayers who have to continue filing. Let's go through the basics of the form, specifically because we get lots of inquiries from taxpayers who reached out to other people who are giving free consultations, claiming to be experts and just giving bad advice. Who has to file the form? So the 8854 is only filed usually by two categories of individuals. U.S. citizens, no matter how long they've been a citizen for, whether it's by birth or naturalization, and long-term lawful permanent residents. A long-term lawful permanent resident typically means you've had the green card for 8 of the past 15 years. The IRS does not take the position that it has to be 8 full years. Hypertechnically, it could be 1 day in the first year, 6 years, and then 1 day in the last year. The IRS could turn around and say, hey, that's 8 years. It's absurd, but that's what they do. Generally, you don't have to use pre-permanent resident status as part of that. So if you were here on a visa, you don't add those years in there. If you made 8833 treaty elections in prior years to be treated as a non-resident alien for tax purposes, you may be able to remove some of those years. So maybe you didn't hit the 8 years. If you do that in the final year, the IRS also sees that as the Expatriating Act. You can find that in the Form 8833 instructions. The Form 8854 is filed when you file your final tax return. So if you expatriate in 2023, right, let's say you filed your I-407, then in 2024, when you file your final tax return, 2023, you include the 8854. You don't file it immediately at the time that you do the Immigration Expatriating Act, such as renouncing or giving up the green card. That's important. A lot of people file it untimely. Excuse me. Taxpayers may have to file the form in subsequent years, depending on whether they have, certain assets in the United States, still primarily things like a 401k. So just because somebody files the 8854, it does not mean they are a covered expatriate. Only covered expatriates will have to pay an exit tax, and simply filing the form does not mean you're covered. You have to qualify for one of these three tests. Not all three, just one of the three. The first test and the most common test is something called the net worth test, if it's $2 million threshold. Unfortunately, that doesn't adjust for inflation. So, you could have bought a house 20 years ago in Northern California, Southern California, it jumped up exponentially, and now you're worth $2 million because you don't have a mortgage. It's totally unfair, but it doesn't adjust for inflation. Maybe it will in the future, but it hasn't in the past. The net income average tax liability test is a little bit different. Taxpayer has to look at the 5 prior years, figure out the taxes that were due, do the average, and see if it's above the threshold at that time. I think now it's around $190,000. It does adjust for inflation. A few things to know about this test is if you file a joint return, you don't split that number in half. So, if there's a joint return, maybe only one spouse wants to expatriate. They're not the high income earner, but based on the net income average tax liability, they may be considered covered. In addition, it's net income average tax liability. The reason I focus on that is if you're overseas and you're making a lot of money, but you're paying a lot of foreign taxes, and then you get a U.S. tax credit. Well, your net income average tax liability may not be above the threshold, even though you pay a lot of foreign taxes because you have the foreign tax credit. Where the IRS really gets you is the 5-year tax compliance test. It's kind of similar to the substantial presence test in the sense that it's a catch-all. If at the time you expatriate, you cannot show that you are 5 years tax compliant, then you'll also be considered covered. Now, the way the IRS does it is it's at the time that you expatriate with the act, such as you renounce or you file your I-407. It's not at the time that you file the 8854. In fact, the IRS updated the instructions a few years ago to really hit on that point. So before you file the I-407, before you renounce and fill out the Department of State forms, you should be 5 years tax compliant. If you're not, Then there's various offshore disclosure programs you could do to get into compliance. We'll get to that in a minute. There are some exceptions. There's the dual status, dual citizen minor exceptions. They're very specific, and you should review them at the time you're completing the 8854. So the most common question, of course, is, do I owe exit taxes? So let's walk down the road again. If you're a U.S. citizen or a long-term lawful permanent resident, you may have to file Form 8854. If you file Form 8854, you may be covered, right, depending on if you meet one of those three tests. But even if you're covered, it does not necessarily mean you will owe an exit tax, okay? If you are non-covered or you meet the exception, there's no exit tax, right? If you are covered, you may owe the exit tax. The reason I'm really harping on this point is because just because you're covered doesn't mean you owe an exit tax. It's not a wealth tax. So you could have $100 million of cash in the bank. That's your only asset. There's no exit tax because there's no mark-to-market gain. It's nothing like that for cash. If you're covered and you have other issues, then you may become subject to an exit tax. There's mark-to-market, which is generally as if you sold the asset the day before you expatriated. There's deferred compensation. If it's eligible, like a 401k, then there's no exit tax at the time you exit, but you may have, you irrevocably, waive the right to rely on certain treaties later to reduce the withholding. If it's ineligible, deferred compensation oftentimes is foreign pension plans. You may have an exit tax, but you're able to use the step up, depending on what your status was when you first earned the pension. And then there are specified tax deferred accounts, trust ownership, grantor, non-grantor, things like that. So if you're covered, take a deep breath. You may still not have an exit tax. If you are not in compliance at the time you're about to expatriate, and hopefully you haven't filed the forms yet, then you could do offshore disclosure with expatriation and get into compliance first. There's various different programs to consider. If you're willful, you do the voluntary disclosure program. If you're non-willful, there's various programs available: streamlined procedures, delinquency procedures, and reasonable cause. We have a bunch of free information on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Have a nice rest of the day.